It's not how much money you make that's important. It's how much money you keep after taxes. The largest expense for many Americans is, well, taxes. And as an attorney, who's not your attorney, what I can tell you is that our IRS tax code is a rule book. It's a rule book that's over 2,000 pages long, going over what you should be paying taxes on and not be paying taxes on. And your goal is to pay the least amount of money in taxes legally. Not all income is taxed the same in the eyes of the IRS. That's why two people who earn the same amount of money can keep two completely different amounts of money after taxes because they're taxed differently, and two people can spend the same amounts of money while one person can get much bigger tax write-offs than the other, which is why it is very important that, especially if you are creating your own income, you're investing in real estate or doing other things like that, it is very important for you to have a good and smart accountant on your side. And even if you don't, well, an accountant can help you strategize your tax deductions and tax write-offs. That way you can maximize your deductions while also making sure you're following the rules. But what I want to do today is go over 7 different things that you need to know. That way you can pay less money in taxes legally. And of course, if you have specific questions, please talk to a licensed advisor in your area. Number 1 is understanding that you're not taxed on how much money you make. You're taxed on your net taxable income. If you invested your money into the stock market and one stock that you invested in made you a $10,000 profit that you sold, and then another stock that you invested in has a running $5,000 loss, well, if you sell this investment, you have $10,000 worth of taxable income. Now, if you also sell this investment for a $5,000 loss, this brings your net taxable income down from $10,000 to negative $5,000. Because you're not taxed on how much money you earn, you're taxed on your net taxable income. Now, of course, you have to actually sell this investment and realize the loss to net this out. But if you have losses, you can use some of your losses to negate some of your wins when it comes to investing. Now, this is where the natural next question is, okay, if I had this loss in my stock market investments, can I use this loss to offset some of my taxable income from my job? And the answer is, well, it kind of depends. The IRS generally likes to compare apples to apples. And so what that means is first they're going to categorize your income because, like what I was saying earlier, not all income is treated the same. If you invest in something, whether it's stocks or real estate, and you hold on to it for longer than a year and then you sell, this is called long-term gains or long-term losses. If you hold on to an investment and you sell it in less than a year, this is called a short-term gain if you make a profit, or a short-term loss. The money you make from a job is called your ordinary income, otherwise known as your earned income. So now, if you have long-term gains and long-term losses, you invest in the stock market, you hold on to your investments for longer than a year, and some of your investments make money and some of your investments lose money, you can net those out right here in your long-term category. If you have other short-term investments where you invest your money, say in the stock market again, and you sell these in less than a year, well, then you can negate your gains and losses in your short-term investments here, and then you're going to have your ordinary taxable income, which is now the money you make from your job. You're going to pay taxes on the money you make from your job. This is generally going to be treated in its own lane, but there are some exceptions to this rule. The general rule is that you can deduct up to $3,000 worth of capital losses against other types of income if you are married. If you are single, filing a single tax return, then it's $1,500. So if you have a $1,500 short-term loss, you can deduct up to $3,000 worth of capital losses on your investments against your ordinary income. If you have an even bigger loss, well, then you can carry that forward to future years. The second thing that you can do is maximize tax-deferred accounts. This might be something like a 401k or an IRA or a SEP IRA or an HSA. 401ks along with 403bs and IRAs are tax-deferred retirement accounts, meaning they are investment accounts that you can put your money into where you can kind of grow your money tax-free. Now, there are some rules and restrictions with this, the whole idea being if you use a traditional 401k or a traditional IRA, you can invest your money into these accounts tax-free, meaning when you put your money in, you don't have to pay taxes on the income. So if you take $5,000 from your income and you put this money into your traditional 401k or your traditional IRA, you don't have to pay any taxes on that $5,000 today. That $5,000 can then grow over the course of your career, and then when you're ready to retire and you pull your money out, that's when you'll pay taxes on a traditional 401k or a traditional IRA. Now, if you use a Roth 401k or a Roth IRA, now you're going to pay taxes when you put your money in. So if you take that $5,000 and you put it into your Roth IRA or a Roth 401k, you're going to pay taxes on the $5,000 today, and then you'll have the after-tax dollars actually being invested. But now your money can grow tax-free, and then when you pull your money out, you can generally pull your money out tax-free as well. If you are self-employed or you have your own business, now you can use something called a SEP IRA, which is a little bit different than a regular IRA because your limits of how much money you can invest are a little bit different. With a SEP IRA, you can invest up to 25% of your net earnings from your business up to $66,000. Essentially, that means you can take a big chunk of your profits from your business, put it to work in this investment fund, and not have to pay any taxes on this money that you earn today, and then you can grow that money tax-free, and then when you pull your cash out, that's when you'll pay taxes. After that, you also have the option to use an HSA, which is a health savings account. Now, before I jump into HSAs, if you do want to learn more about how to actually invest your money yourself, that way you can get better returns, get some of the tax breaks, and start generating cash flow, even if you don't have a ton of money, my company, Market Insiders, has a free ebook on how to start investing and how to start generating passive income. So if you want to learn more about how to start investing and build your investment portfolio, you can read this ebook for free, and I'll put the link to how you can download this ebook for free down in the description below. The way that HSAs work is you can put a little bit of money aside, tax-free, into this account, which then you can use to pay for things like deductibles or co-pays or some other qualified medical expenses that you have to pay out of pocket. So now you can essentially pay for these expenses tax-free if you put this money into an HSA. Now, the caveat here with the HSA is you have to have a high deductible with your health insurance in order to qualify to have an HSA. That means you have to have a high deductible health plan or HDHP, and in 2023, the minimum deductible you have to have on your health insurance to qualify for an HSA is $1,500 for an individual or $3,000 as a family. The third thing that you can do is take advantage of the new clean energy tax credits. In 2022, President Biden signed the Inflation Reduction Act, and one of the provisions in the Inflation Reduction Act was that if you spend money to make your home more energy efficient, you can get a tax credit for that. This tax credit is available from now until 2032, and it gives you a 30% tax credit on energy efficient improvements on your home. Now, of course, this includes things like solar panels, but it also includes things like replacing your exterior windows, replacing your exterior door, improving your AC, and improving your furnace. Now, there are some rules associated with this, so definitely talk to an accountant or at least read the rules before you go and actually implement this, but this is a way now for you to improve your home and get a tax credit while you're doing that. Number 4 is really understand that not all income is taxed the same way. According to the IRS, there are 3 general categories of income. You have earned income, otherwise known as ordinary income, you have a portfolio income, and then you have passive income. Your earned income or ordinary income, this is the money you make from your job. This is your W-2 income. Your portfolio income, this is the money you make from things like your stock market investments. If you hold on to a stock and you buy a stock and you sell it for a profit, that is your portfolio income. Passive income would be something like your rental property income. If you own a rental property and it's paying you with cash flow, that is your passive income. Do you want to know which of these 3 different types of income comes with the highest tax rates and the lowest tax write-offs? Well, it is your ordinary earned income. The money you make from your job comes with the highest tax rates and the lowest tax write-offs. When you go and invest your money in something like the stock market and you hold on to this for the long term, well, now you qualify for long-term capital gains. And at the time of recording this video, the top tax rate for long-term capital gains income is 20%. While at the same time, the top tax rate for now your earned income is closer to 40%. So if you make a lot of money, and you make a lot of money from your job versus a lot of money from your investments, well, you can pay much less money in taxes on your investment income than your earned income, just because that's what the tax code says. What does this mean? Well, it goes back to the importance of being financially educated, because now if you are investing your money, because not everybody can be a business owner, not everybody's going to go out and invest in real estate, but everybody can be an investor. If you start investing your money, well, now you can take advantage of some of these lower tax rates and you're building wealth while you're doing it. Now, of course, if you want to learn more about this, you can check out my free ebook down in the description. Number 5 is maximize your deductions, especially if you have your own income. So if you're self-employed, or if you have your own business, or if you're investing in real estate and you're creating your own income, now you can definitely try to maximize your own expenses and write-offs. Now, if you don't have your own income, this is where you want to make sure you at least maximize the standard deduction. See, the way that your taxable income is calculated is you make money, whether it's from your job or your business, you take your deductions, and then this is now your taxable income. If you don't have a lot of write-offs, you can at least maximize your standard deduction. This is what everybody can qualify for. But if you create your own income, if you're self-employed, or if you have your own business, well, now the question is, how can you maximize these deductions in a way that will give you value for your business and maybe some value for your life as well? 2022 was my biggest year for travel really ever up until now. And in 2022, I spent a lot of time in Airbnbs, a lot of time on planes, a lot of times in hotels. And I had to spend a lot of time in different parts of the country. Like, I spent maybe 2 months or so in San Diego. I spent about a month and a half in Manhattan. And when I went, I lived there with my business partner. So now me and my business partner are living in an Airbnb. We had to go fly out to these places, and then I had to go and work there. I had to eat at restaurants, I had to meet with people and do a lot of business there because I went there for business. But along the way, I also got to spend time in San Diego and Manhattan, which are beautiful cities. Now, I should also clarify that my business partner is my wife. And so now me and my wife got to go to these places like San Diego, and it was a tax deduction. Yes, I was there for business. I was meeting a lot of people. I was doing a lot of interviews. I was working with a lot of people. I was there for work. But the expense to go there and live there now became a tax write-off because, well, I had to go there for work. This was a deduction. Same with meals. In 2022, there was a 100% meals deduction because we were just coming out of the pandemic, which meant if you went out and ate at a restaurant and you had a business meeting, if you were eating with your employees, if you were eating with business partners, if you're meeting with other clients, well, now these meals that you're eating at these restaurants are a 100% write-off. Now, it's still a write-off, but not a 100% write-off. Another popular deduction right now is the Section 179 deduction, which is a heavy vehicle deduction. Essentially what it says is that if you need to buy a heavy vehicle for your business, well, then you can write off a big chunk of that vehicle right now. Like in 2022, my accountant called me and asked me, Jaspreet, what are your thoughts about a G-Wagon? And I was like, well, they're nice cars. What do you mean? He's like, I think you should buy a G-Wagon. Like, why are you saying that? And he said, well, because we have the Section 179 deduction, which says that if you go out and buy a heavy vehicle like a G-Wagon, then you can write off a big chunk of the vehicle over your taxable income. So you can reduce your taxable income because now you have a G-Wagon. And I was like, well, I don't really need a G-Wagon. I don't really want a G-Wagon. I don't know if I should do that. And he said, look, you are an influencer. You have this brand on social media. And because you do, well, then you can justify to the IRS that you need a G-Wagon to justify this lifestyle and this influencer brand. Now, I didn't go out and buy a G-Wagon because for me, I don't want to go out and just spend $1 to save 40 cents on taxes. I'd rather use that money in a place that's going to give me a bigger return on my business. But you saw a lot of people going out buying Hummers and pickup trucks and heavy trucks because now they wanted to capitalize on this Section 179 deduction. I'm going to talk about real estate even more in just a minute, but another deduction that's been very popular amongst real estate people is travel deductions. Because now if you go fly to Florida, or you fly to Hawaii, and you're going there to look at some real estate, even if you don't buy any, well, now you're going there with the intention of looking at real estate. Maybe with a real estate broker. Maybe you look at some properties. Well, now if you do that, if you go there with the intention to look at real estate, well, now that trip, that little vacation that you had to Florida or Hawaii, is now a tax write-off because you're going there for business purposes. Yeah, maybe you have to go and eat at some nice restaurants. Maybe you have to play golf there while you're on this business trip. But if you're going there for business purposes, now the trip can be a tax write-off. But again, this is where you have to make sure you have a good licensed accountant on your side, because this person will now make sure what you're doing is in line with what the rule book says, and they will make sure that you stay out of trouble because you don't want to now press the line and then get audited and then have to pay a whole bunch of money in fees and fines. So make sure you do it the right way. The sixth thing that you can do is use debt strategically. Now I'm going to talk about this on a big scale, then kind of talk about it on a smaller scale. But a fun kind of example of this is in the terms of buying a plane. Let's assume now that you run a business and your business made $10 million of profit, so you're making a lot of money. You have $10 million in the bank account, and that means you're going to have a big tax bill associated with that. Well, if you go out and you buy this $20 million plane, that is supposed to be a plane, this plane costs $20 million. Well, you don't have $20 million to go out and buy this plane, but what you can do is you can finance this plane. You can go out and put down $2 million to buy the plane and then finance the other $18 million. So you got $18 million worth of debt. You put down $2 million. Now you own this plane and your bank account has $8 million. Well, now what you can tell the IRS is, yeah, I made $10 million. We only have $8 million in the bank account, but I bought this $20 million plane. So now you can take a $20 million write-off on your taxes. So now you tell the IRS, my taxable income is negative $12 million because you financed the plane. Now you have a plane, you have $8 million in the bank, and you have $0 of your tax bill. Then next year, if you make another, say, $10 million, well, now you can take this negative $12 million and use it to negate these taxes as well. And then you can tell the IRS, hey, I made another $10 million. I have this $12 million loss from the previous year. And now you show that, well, I have a negative $2 million taxable income again. And then you can carry this $2 million loss into the next year as well. And now you're going to use your income to, well, pay down your payments on this plane. Of course, anytime you take on more debt, it comes with more risk, but this is where now you can see how if you use debt strategically, it is a way for you to also limit your taxes. How else do people do this without buying planes? Well, you've seen people do the same thing with cars. You can do this with business machinery. The key here is you want to make sure that you're not over leveraging yourself to really run into financial danger where now you're trying to finance all these things to limit your taxes, but now you're on the verge of going bankrupt. So again, don't just spend money with the goal of spending $1 to save 40 cents. Spend money strategically in a way that's going to help you increase how much money you're making. And if you can get a tax write-off for that, even better. But don't get into the habit of spending $1 to save 40 cents because you're still losing 60 cents along the way. And then finally, number 7 is invest in real estate because now you can generate cash flow. You own a hard asset, something that you can see, feel, and touch, and you get the tax breaks that real estate has to offer. I know a lot of people who are doctors, and a very common question that I get from all of my doctor friends, especially when they start working, they start making the big bucks, is, man, I'm paying a lot of money in taxes. Is there anything that I can do? And one thing that I always recommend is go out and invest in real estate because now you'll be working to build wealth, you own a hard asset, and you can also benefit from some of the tax breaks as well. So let's assume now that you went out and you bought this property. Let's assume it's $1 million. You could do the same with a $100,000 property. The same concepts apply, but you buy this property for $1 million. And this property, let's assume that it generates $50,000 a year of profit from cash flow. So this is a 5% return, $50,000 worth of profit. Well, now not all the income is going to be your taxable income because now you also have to take out your other deductions. So we already took out the deductions for the building. That's how you got this $50,000 worth of profit because maybe you generated $200,000 of revenue, but then you have to pay for your property manager, you have to pay for your water bill, you have to pay for the utilities, you have to pay for the maintenance, which brought you down to $50,000. Rough numbers. Now, out of this $50,000, you have to pay for your other business operating expenses. Maybe you have to have a cell phone to run the business. Maybe you need a laptop to run the business. Maybe you need your truck to run the business. Maybe you have to pay for gas to run the business. Maybe you have some meals for the business. So now you can write down some of these expenses, which let's just assume your business expenses bring you down to $40,000 worth of net income. The next thing that you can do is you get to tell the IRS, hey, this property that I bought is 1 year older, so I deserve a write-off for that. That is called the depreciation deduction, where now you depreciate the value of the building. So now this is where the first thing you have to do is you have to separate the value of the land from the building. So let's assume that when you bought this $1 million property, $200,000 was the value of the land and $800,000 was the value of the building. Well, now you can write off a piece of this $800,000 every year until you write off the entire building from your taxable income. Let me show you. If you invest your money into a single family home, then you will get to write off 1/27.5 of the value of the building each year over 27.5 years. If you now buy a commercial building like this one is, then you get to write off 1/39 of the value of the building. So now we know that the value of this building is $800,000. You take the $800,000, you divide it by 89, which is just over $20,000, which means that now you get to take an additional $20,000 write-off just because now your building is 1 year older. This is what's called a paper deduction. You have $40,000 in your bank account, even though this property made you $50,000, then you had your other operating expenses. So now you made $40,000. You take this $20,000 depreciation deduction, which is only on paper, and then you tell the IRS, hey, I only had $20,000 worth of taxable income. Now you have less taxable income, which means a lower tax bracket, which means lower tax rates, which means less money that you pay in taxes. Now, again, you have $40,000 in your bank after paying for all these expenses, and you're only paying taxes on the $20,000. Again, this is why you want to make sure that you talk to a licensed and professional accountant in your area, because there's a lot of rules and a lot of regulations, especially when it comes to real estate investing, and you want somebody who is a professional to guide you, because you want to stay away from the red flags and make sure you follow what the rules are. Rich people in general pay a lower tax rate than regular people. And you want to know the craziest part? This is 100% legal. How do I know? Well, two reasons. For one, if it was not legal, all of these people would be in jail. And the second way that I know is because I've spent a lot of time studying the federal income tax code. And what I can tell you as an attorney who is